This is Natalie Pace, and today we're going to be discussing the fact that stocks have dropped about 14%. So, will the current correction begin a bear market, a recession? What's your best strategy for 2025? What happened to the Magnificent Seven and Bitcoin? Why are they down so much? All this and more in my free video conference. We're going to get started in just a moment. Remember, you can always email us at info@nataliepace.com. And we'd love for you to join us at our next online financial freedom retreat where you can learn the life math that we all should have received in high school. And that is April 25th through the 27th. Email info@nataliepace.com to learn more. We'll get started momentarily. Okay, so just 2 days ago, we were this close to a bear market. The S&P 500 has to drop to 4,915.32, and that would be a correction of 20% in order for the bear market to continue. So it dropped all the way down to 19%. And then, of course, yesterday we had this massive rally, and then today we had another sell-off. So we're going to talk about a number of things. And these are some of the things. Again, I'm going to be posting this as well on my blog. So you'll be able to access that, nataliepace.com/blog, or go here to the menu and click on blog. It will be the first blog that you see there. So let's look at some of the things that we're going to be talking about today in today's video conference. So is it a recession or a bear market in the cards for this year? The VIX, so that's the fear index, is pretty high. Oil is below break even, and what that means. The Magnificent Seven, everybody's been hearing that term. What does that mean and what's going on there? Will stocks rally again? We'll talk about whether or not there might be an emergency interest rate cut and your best wealth strategy for 2025. So let's start with whether or not there's going to be a recession or a bear market. The odds have gone up. So we have seen economists saying there's a 60% chance of a recession this year. That's JP Morgan. We've also seen that Jerome Powell, he's the chairman of the Federal Reserve Board, has said that the tariffs are going to slow down growth. We were already pretty slow. So they had slowed down their projections from December to March, and then they're now saying, hey, it could even be worse. So economists never say there is absolutely going to be a recession. And if you wait for the headlines, you're always going to be late. So we saw that in the Great Recession, the actual recession didn't get announced until October of 2008. The markets had already dropped about 40% by that time. So if you wait for the headlines, you're closer to the bottom, and you may have to hope and pray that you crawl back to even. Whereas if you just are acting your age and you're properly diversified, in our sample pie charts, I'll talk about this a little bit more towards the end of the video conference, we're overweighting safe. And that strategy, simple modern portfolio theory, it's very easy. It's as easy as a pie chart. Earned gains in the dot-com recession and the Great Recession when most people lost more than half of their wealth. So as we get closer to retirement, it becomes really important for us to be having an age-appropriate, properly diversified plan. And in a debt world, we don't want to have paper losses on the fixed income side. So we actually need to know what's safe in a debt world too. Again, it's important for us to be the boss of our money and not just have blind faith that somebody else is doing this for us. Now, the VIX, the fear index, is pretty high, and that has a strong correlation with where stocks go. So whenever we see that people get really afraid of the economy or afraid that we might have a bear market or a recession or that they're going to lose money in stocks, we see the stock market go down because they sell and they put it more into cash. So when people start selling, prices start dropping. So that's another indicator that there could be weakness in the stock market. Oil is below break even. Now, this is really good for consumers, and consumers drive about 70% of the US economy. It's good for consumers, but the sad thing is that it is very bad for the oil and gas producers because a $60 a barrel of oil, is below what they can actually drill. So this is something that can actually increase unemployment, especially in the Gulf states. And also, ultimately, it could actually make prices go higher because it is a supply and demand issue. We actually have had a little bit of reduced demand, and that has a lot to do with the move to electric vehicles. So gasoline is only, the price of gasoline is more relevant for ICE internal combustion engine auto owners than it is for electric vehicle owners. In the US, we've seen a big move towards EVs, but in China, it's been massive. And that's been responsible for a lower demand and also now lower prices. So, again, this is good for anybody who puts gas in their car, but it's not necessarily good for the economy or for the oil industry. One other reason it's not great for the economy is, as well as the tariffs, is that we've seen the big CEOs pull back on their capital spending. When the CEOs get worried about the economy, will they be able to sell things? Is it going to be more expensive? Will they be able to turn a profit? Then they start like everybody else, tightening their belts. And that is going to mean less GDP growth if we have consumers spending less and we have corporations spending less as well. So that's the trend. Of course, things can change, but that's the trend so far. Now, another thing I wanted to show you is that the Magnificent Seven are basically the trillion-dollar technology companies, right? Amazon, Apple, Google, which is Alphabet, Meta, Microsoft, Tesla, and NVIDIA. Now, these companies more than doubled in 2023. They were the super performers of 2024. So I actually had a client who said, well, hey, if I said, you missed out on a lot of gains because you didn't have large cap growth or an extra hot slice of technology. And he was like, well, wouldn't I just have lost my money? And the truth is, no, you would not have. All right. So it is important to always have an age-appropriate plan that is properly diversified. Again, that's another reason why you want to know what you own and be the boss of your money. Because if you, let's say, said, I want a conservative plan, and you didn't have any large cap growth, then you didn't really have any of the gains that were made in stocks over the past 2 years, which has actually been quite extraordinary, over 50% in a 2-year period. So let me show you what it looks like. Here is the Magnificent Seven performance. So they have really been underperforming, right? Stocks in general are down 14%. You can see that most of the Magnificent Seven is down a lot further than that. However, they still have extraordinary gains over that 2.5-year period. So when you think about what you should be doing, it's not jumping all in or all out. It's not day trading. If you want to day trade and you want to try to figure that out, that's a different thing. Most of us want to have our nest egg, and we want to earn money while we sleep, and we don't want to have an extra job. And if that is the case, then you just want to have an age-appropriate plan that's properly diversified, that you rebalance once, twice, or 3 times a year, because that's part of the key as well. If you rebalanced at the end of 2024, right, you would have been capturing gains at the high. And then if the Magnificent Seven goes down a little bit, it's okay. And also it's age appropriate, right? So you've got a slice here instead of everything that goes down by a quarter. You've got a little slice that went down by a quarter, but you had already captured a bunch of gains. Again, this is actually easy as a pie chart once you learn it. Before you learn it, of course, you might think, oh, it's really complicated, but it's not. It's literally what we call the life math we all should have received in high school. So will stocks rally again? Now, again, remember, I am going to be posting this blog and within the next 24 or 48 hours. So you'll be able to look back, look at my charts, and read everything as well. There can be what we call relief rallies in between a downturn, right? So we saw one yesterday. We saw that stocks dropped 14%, then they dropped 19% on Tuesday. And then on Wednesday, we had this massive relief rally, but it didn't last. Today, we saw stocks sink again. So, what tends to happen when we're entering a bear market or when we're entering a recession is what I call a series of unfortunate events. And in between, there are many relief rallies, but they don't actually get any traction. So I'm going to talk to you a lot more about this in that blog. But just as a reminder, in the Great Recession, in the beginning of it, we saw that Bear Stearns had a big problem, right? And then they were rescued by JP Morgan, and so there was a relief rally. But then we saw Lehman Brothers declare bankruptcy, and then everybody freaked out, right? And the markets really dropped. And all of the feds and the Treasury Secretary, everybody, the chairman of the Federal Reserve, they were saying, don't worry, it's not as bad as it seems. And then, of course, a month later, they were in Congress saying it is worse than it seems. And that's when the recession was actually announced, and the markets had already dropped about 40%. You were closer to the bottom at that point. And then, of course, we had GM and Chrysler declare bankruptcy early in 2009, and the exact bottom was March in 2009. So the high was October 2007, and the low was March of 2009. So it typically can take 18 to 24 months before we actually hit the bottom. Now, results can vary. Obviously, in the pandemic, we had the shortest one that we have ever had in history, only 3 months, but we don't usually print up $5 trillion and throw it at everything with a pulse. That's going to be even more problematic today because, we still don't even have an agreement to raise the debt ceiling. So these are things that, again, it's not like you should be watching the news every day and freaking out. What you should have is you should have a plan that if things go south, your plan is still going to be protecting your wealth. And if things go up, you have enough, an age-appropriate amount that's going to increase. And the rest of it is going to be increasing at a safe pace, which would be about 4% right now. If you're reaching for yield, you might be actually suffering paper losses. So it is important to know what's safe on the safe side too. And this isn't rocket science. All right, so an emergency interest rate cut, we've been seeing a lot of headlines about that. The truth is that is probably not baked in. Wall Street doesn't think that's going to happen. They think that the Feds are going to pause. The next meeting is in early May. I think it's around May 7th. I do have a calendar that you guys can look at for all of this. Let me show you how you can access that. If you go to nataliepace.com, and then you just simply scroll down a little bit, you'll see here that I have a little calendar link. So the next Federal Reserve meeting is going to be on May 6th. May 7th will be the announcement on that Wednesday. So, they're really not expected to raise interest rates at that meeting. About 74% of those professionals surveyed said, we don't think so. It's going to be a pause. So there may be 2 more rate cuts this year. However, tariffs have complicated the situation because that could actually increase inflation. So if we see inflation get sticky or go up, the Feds are not going to want to cut interest rates because that is keeping the monetary policy tight is one of the ways that they fight inflation. So it's become a bit of a more complicated situation. And that's one of the reasons why I don't think it's a great idea to just listen to all the news and read all the blogs that you see, is that if you really don't know how to put that into the big picture, it's just a bunch of financial noise that might actually increase your stomach acid. And when you're doing emotional choices rather than rational choices, you're more likely to make the wrong answer. So, what is your best wealth strategy for 2025? I'll put in a sample pie chart for you guys, but the truth is your best strategy is always age appropriate, 10 funds, rebalance once, twice, or three times a year. I have an investor IQ test that you can take. I have a rebalancing IQ test that you can take. Those are free. Just email info@nataliepace.com so that you can test to see how much of the life math that we all should have received in high school that you already know. And if you know it, fantastic, then those guidelines will help you to make sure that you really are protected whether we enter a bull market, stocks go up again, or a bear market, stocks continue to go down. Email info@nataliepace.com and just ask for those blogs if you would like them. Also, again, we are going to have a financial freedom retreat. It's online, so you can attend from anywhere, no travel, no lodging expenses. And that is going to be April 25th through the 27th. So I do encourage you to check that out. Just go to the homepage at nataliepace.com and then, sorry, took us to the wrong thing. So here we go. Scroll down, and if you click on the spring right there, April 25th through 27th, you can learn everything. You can learn how much it costs. You can learn the hours. You can read testimonials. One thing I always tell people is that you can read about these time-proven 21st century strategies that earned gains in the dot-com and the Great Recession, pandemic, outperformed the bull markets in between. You can read about it in the ABCs of Money, 6th edition. You can learn and implement it at our Financial Freedom Retreat. And if you are a busy professional, or if you just want to know what you own now, I do offer an unbiased second opinion through my private coaching. Now, why would you want to do that? Why is it unbiased? I don't sell financial products, so I have no incentive to tell you to buy this or that. My whole thing is to help you to be the boss of your money so that you can make informed decisions. My whole reason for even doing any of this is to empower Main Street investors. That's it. So do reach out. I'm going to go ahead and answer a few questions that were emailed to us. If you are on our volunteer team, you are welcome to email us questions before these monthly free video conferences, and I'm happy to answer them. One of the questions was, this person wanted to know if she should be putting her money in a Mexican bank and earning 9 to 10% interest. And so my answer to her is this. On the side where you're supposed to keep your principal and earn a small yield, right? The safe side that's not supposed to lose money. You want to, the mantra we're saying is keep the terms short and keep the credit worthiness high. So Mexico is rated BBB minus by Fitch Ratings. That's the lowest rung of investment grade. If it gets a downgrade, it's in junk bond status. So that means that that's not great. Okay, so that the credit quality there is an issue. In terms of the terms, if you're going to do a CD, you could do a shorter term, but you still have the credit quality problem, which I wouldn't be interested in. We also say if you are doing certificates of deposit, observe FDIC insured levels. And they're lower in Mexico than they are in the US. I think it's only 160,000. And then the other thing that you have to deal with is foreign exchange, currency exchange. So that can wipe things out. We've also seen that Mexico has had crises where they had to devalue their peso. So I think you should become a little more familiar. If you just Google that, there's actually a wiki page on when the peso went into a crisis in the 1990s. So I would look at all those things and then you make an informed choice. But I think that fixed income people who want to preserve their principal and earn a little bit of money, they should be adhering to two important mantras in addition to keep the term short, the credit worthiness high, and observe federal insured levels and also rolling maturity dates. I would also be observing one mantra, which is never reach for yield, And the second one, which is a quote from Will Rogers, where he says, I'm more concerned with the return of my money than the return on my money. All right, the second one question that came in was about some high yield funds. And I want to show you what those look like. So it's the same sort of thing. If the higher the yield, the higher the risk. So one of them was this one. That's the market volatility. The NEOS NASDAQ 100 High Income Fund. So you can see here that the yield is 15.61%. But if you subtract the expenses and the losses, you're earning about what you would be earning without the volatility and loss of principal, about what you would be earning if you were just doing a certificate of deposit. There's one other problem, however. This is a NEOS fund. So we're saying keep the credit quality high, right? NEOS has only been in business for 3 years. It's by a CEO that typically only has businesses for 5 years. There are all kinds of problems that can happen if you invest in a fund company that has got this kind of track record. They can charge you a maintenance fee out of the blue if they get into trouble. There's all kinds of things that can happen. So in general, I would keep the credit quality high of the fund company. When we're doing the fund companies at our retreat, we stick to an AA rated, I think it's AA minus rated fund company. And that's what we're using. So I would not be investing in just any old fund there. And then the last question came in from Sterling. And he was saying, hey, what are we going to expect for 2025? And obviously, that is exactly what I'm addressing in the blog that I'm going to be posting and also in this complete video conference. So in general, I would say the odds of a recession have definitely increased. We are overweighting 20% safe in our sample pie charts. That means if you're 50, you have overweighted 20% safe, you only have 30% at risk. If the worst thing happens and stocks drop by half, you lose 15%, and hopefully you're going to be making it up on that 70% safe that you have. You're in a lot better position if you lose only 15% than someone loses half of their wealth. So this is really, again, it's a time-proven strategy. It's not market timing. It's actually modern portfolio theory. And the regular rebalancing just once a year or at minimum, 3 times a year at most. And that's easy to do once you learn, again, these simple pie chart system. It's absolutely simple. All right, so thank you for joining me. I'll go ahead and stop for a moment just in case anybody has any quick thing that they want to say, and then I'll come back and we'll close out. All right, and I want to also remind you that I do daily money tips. So you would need to join my broadcast channel on Instagram or follow me on LinkedIn or Facebook. Let me show you where you can get that. Also, remember, you can share this, it's free with your friends, and that's on my YouTube channel or as a podcast if you prefer listening to it just audio on Substack, Apple Podcast, or Spotify. So let me show you how you can access all of that. You can simply go again to nataliepace.com and right under my picture, Facebook, X, Instagram, LinkedIn, email, Spotify, Apple, and YouTube. So all of the social media is there. Remember that ISPs, we are a money site, right? So we put a lot of money words in our emails. You might not receive them. They might go into your spam. They might get blocked. So it's really important to follow me on social media if you would like to, learn more. And again, it's cumulative. So it may feel like a lot in the beginning and that you're not understanding everything I say. But once you speak the language, this becomes super easy. And again, this is something we should be taught in high school and college. I have a lot of people, very, high level professionals that are clients or come to the retreats. And It's just life transformational once you get it. One other thing is that you can actually learn how to save thousands annually with smarter big ticket choices, and that's something else that we really offer in the retreat and also in the private coaching. So thanks again for joining me. Remember, nataliepace.com, Natalie Wynn Pace on a lot of the social media. It's WYNNE. And email us at info@nataliepace.com. We'd love to see you at our next Financial Freedom Retreat, April 25th. And we're having a stock masterclass the following Saturday on May 3rd. So check it all out and email us and join us. Thanks again. And I'll see you soon.